Thank you for joining today's webinar. Today we'll be talking about HFF replenished volume in more detail. We'll be talking about mainly certain iceberging action in crude oil and gold, but not just iceberging, but also we'll cover areas of high replenished volume created in a tight area of price action. Before we proceed, let's read this standard disclaimer. HFF are not registered advisors by any state law and never presented themselves as such. Under no circumstances shall HFF be liable for any loss or damage the user incurs as a result of any trading or investment based on any information or material received through any HFF software, website, or presentation. So let's look today at some special situations where there is a high replenished volume, and we'll look at two instruments, crude oil and gold. But before we do that, let's first discuss very briefly what really replenished volume is for those who might not have a very clear idea. We, roughly speaking, define replenished volume as aggressively provided liquidity or absorbing liquidity or stopping volume. You could assign that volume all those different names. What it means really is that whenever all the available liquidity is exhausted in the order book, whatever volume is executed after that, of course it requires a special algorithm to determine that. Whatever volume is executed after that is denoted by us as replenished volume. So that, there are always two sides to the trade. So whoever is providing liquidity may have a certain view on the market, and whoever is taking liquidity, in other words, hitting the bid or taking the ask, may have another view on the market. They may be opposing views. They, in some special cases, can be even the same views, but with different time frames. So what we need to do when we look at the replenished volume is to consider the context of previous price action, order flow events, and also we need to look at where we are in terms of where the price is in terms of the position with respect to daily range, intraday price action, or even more. Even a multi-day time frame. So let's look at some interesting situations that have occurred fairly recently in crude oil. Let's start with crude oil first. Let me make this visible area properly adjusted. So what I'm going to show next is a multi-day chart, just the price chart for now of crude oil, and this chart runs from May 19th till June 12th, so till about a week ago, and we'll specifically focus on what happened right here at this local high, which in fact, so that was on May 23rd at 104.50, and this local high turned out to be, if you would like, a global high for the next almost 2 weeks, really, until it was finally broken on June 9th. So let's look at what happened at 104.50, and when we look at this case, we don't look at it just because it worked, but we assign it that context that I mentioned before, which helps us always to determine whether a situation like we will look at may result in a trade that you could fade this move upwards or potentially make it a continuation trade to the upside. So let's look at a replay of those few minutes where the price hit the high of the day, which we, of course, at the time didn't know it was going to be the high. And I'm going to play this in a replay mode it's sped up to 20 contracts per second, and it will flag the boxes where replenished volume exceeds 50 contracts. This is crude oil as orange. This is just specially made for this presentation. So, as you know, for example, for crude oil, we flag boxes where price is higher than 100 contracts at either bid or ask with green color to alert you to the possibility that significant volume is being executed. For this presentation, we programmed it so that when the replenished volume is above 50 contracts, which is fairly significant for crude oil in particular, it will turn into a green color. So let's see how this situation played out. Not quite in real time. In fact, it's sped up. But this is how the price was approaching 104.50 area. It first time hit it, and all of a sudden it trades more than 100 contracts, and it just keeps adding to it. And you see as the replenished volume exceeded 50, it just turned orange. Just so we see that that's an area of high replenished volume. You see immediately that there was, at the first attempt, 394 contracts executed at that price, which is a very high volume, out of which 150 was replenished. So someone is actively stopping this move at this level. The next minute, another more than 200 contracts added, out of which you see is more than 200 is replenished. So this is becoming a significant order flow resistance level as we watch it live, if you were to watch it like this. So this is playing out over a 3-minute range. So the third minute, yet another attempt to break that level. And again, a lot of replenished volume. And then, as you see even here, one tick below, there is a lot of replenishment on the bids. So someone was probably still trying to go to the upside and break this level, but at the same time there was already aggressive taking liquidity, hitting the bid and trying to squeeze this price down. So when something like this happens in crude oil, it should definitely alert you to the possibility that this 104.50 area is going to be significant. When this high volume on the ask happens, this is total of about over 800 contracts. Then we know that this level is going to be a sort of an anchor point for future price action. So what is also interesting is that in these 3 minutes that you see, it seems like a long time, but in fact, most of the 800 contracts that were traded here at this particular price traded within probably less than 10-second time frame. So those were short bursts of liquidity and attempts to break that level, and all of those attempts failed. And then price just continues to do what it does. And in fact, that same day, which was a Friday, the price never breaks this level. It never even comes within it. The closest it came was within a tick of it, which was around this time, 11:54 a.m. Central Standard Time. And then it just slowly drifted away. So what is advisable to do in that situation? As you watch it live, you may try to fade this move with a tight stop if that's what you want, but it's always good to consider what happened before and where we are in terms of daily range and potentially previous order flow events. So if we look at this multi-day chart, I was showing you the area right here around 11:40 a.m. on May 23rd. And that day, if you look at the graph here, it's a little small, but the price was going up, essentially only going up, but not by too much, 70, 80 ticks. So we are at the high of that daily range. In fact, it was a high of that week's range. So if smart money was trying to get into a long move, you would logically ask yourself, why wouldn't they do it somewhere lower? Why would they do it at the very high? Of course, it can always happen that it just keeps continuing, but the logic tells you that more likely it is the smart money opposing the move. So at least based on that big picture logic, you would favor fading this. And you can always wait for confirmation as to what happens in the next few minutes or hours. If it's a big iceberging action like this, where you have 800 contracts at a level, it will likely be retested. In fact, it took almost 2 days. After that we had weekend, and then on Sunday the price was squeezed down about 50 ticks away from that level, and it started slowly drifting up. Monday morning, early morning, it was in the European session, it came back to that level and spent almost 10 minutes there. I'm not going to show that particular part, but it was, again, that iceberg was still active, so there was still more replenishment going on at 104.50 until finally all those algos or orders that were trying to break it gave up and price comes down. So these big replenishment areas have an interesting property, that they are attracting the price and repelling the price at the same time. Almost seems contradictory, but if you think about it, initially it attracts the price because there is a lot of volume executed there, and there is always an attempt to break that level. But at some point, if, so to speak, all available resources have been exhausted, then everybody gives up. And as you can see, what happened in the next few days is that price went away from that level almost 300 ticks all the way to this level. But even once it failed here, price retreated almost 100 ticks, then made another push, which did not even get it back to that level, and then price gave up essentially and dropped 200 ticks within almost a few hours, really. So these areas are important to have in mind, and even if you don't trade them, it's good to know that they exist, because if you just look at this chart without knowing anything, why would you don't understand why the price turned around here. Of course, we cannot explain all the turns, but we can explain some based on the volume information that we provide. Another interesting thing, by the way, here to support the idea that you should fade this iceberg, if you will, was that we can look at what happened that very day, even a few ticks below that level. So right here is the area where I showed the replay of the iceberging action, a lot of replenished volume on the ask. But even before, we had some move on strong volume, and as we reached this area, 104.45 roughly, there was a lot of replenishment here. So already an attempt to stop this move, along with, not surprisingly, algorithmic ask volume, a lot of replenishment here on the ask, a lot of replenishment on the bid, which on an up move means aggressively selling, and a lot of replenishment in all these situations. So that was already at 104.45 more than an hour before, and as price gets only 5 ticks above this high replenishment area, there is still resistance in the order flow. So that tells you that someone is really taking it seriously to load up on a short, if you will. So that also supports the idea that this area here, 104.50, may be a good candidate to fade, or it could really become a good resistance level. So that's how it played out in crude oil, and you have seen on this big picture chart that later it dropped almost 300 ticks total. Of course, you would have to wait in the trade for multiple days.